Okay, most investors think the only way to produce income from stocks is to invest in boring, low-growth dividend stocks. But the average dividend yield of the S&P 500 is only 1.5%, which means that you're not going to make much income unless you invest a huge amount. But what if you could have your cake and eat it too with your trading? What if you could invest in high-growth stocks that don't pay dividends and still get a great income yield of over 10%. In this video, we teach you a simple option strategy that allows you to do just that. In fact, we'll show you an example of how a trader produces $25,000 in cash income on a stock with no dividends. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to have developed numerous 7 and even 8-figure per year traders. We hope you agree. This is the top YouTube channel to help you grow your trading account.
Hi, I'm Seth Freiberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And the largest frustration for traders all over the world is the fact that they feel like they're absolutely forced into making a choice between growth stocks and income-producing stocks that pay a dividend. Because the truth is that income-producing stocks are generally boring and don't tend to have these parabolic, massive rallies where the stock can double or triple or even quadruple in very short periods of time. Instead, they move more like tortoises, grinding upwards over time, perhaps, and yielding in many cases tiny dividends, which hardly make the whole thing worth it. But for people who really want, or in some cases need, the cash flow from these dividends, they're kind of trapped into those boring stocks and they lose out on the much more dramatic gains of growth stocks, many of whom have been in business for years, growing dramatically, but have never actually paid a dividend. Stocks like Amazon, Alphabet, Netflix. I mean, these are major stocks with major growth potential, but they don't create any cash flow for their owners at all. So what do? Are you just stuck with this trade-off? And the great news is that you absolutely don't have to just accept that. You, in fact, can create an income stream from non-dividend paying growth stocks. And the purpose of this video is to teach you how. And that's through an options trading strategy known as the covered call, which some of you may have already heard of. But for those of you who haven't, I'm going to do a super quick review of what covered calls are so that everyone watching this video is on the same page. So first of all, a call option on a stock entitles the buyer of that option to buy 100 shares of a stock at a certain price called the strike price of that call option at any time after the call buyer buys that call option. The call buyer pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go way above the strike price of that call option, in which case the buyer can exercise his option and force the call seller to sell his shares at the call option strike price, which is lower than they're worth. But it's also important to keep in mind that at expiration, if you've sold a call and the market closes below the strike price of the call, then unless the call was previously exercised, the call expires worthless and the call seller just pockets the premium. So that's how call options work. Now, a covered call starts out with your buying 100 shares of a stock and then selling a call option on those shares that you own, usually at a strike price at or above the stock's current price at a fixed interval, like once a month or once a quarter. And so a covered call can have 2 possible outcomes. If the stock closes at any price below the strike price on the day the call option expires, the trader just pockets that call premium he received initially. But if the stock closes above the strike price of the call option he sold, then his shares get sold for the strike price of the call he sold. And again, he pockets the premium that he originally collected for selling that call. So that's the way covered calls work. Okay, so with that said, let's give you an example of how this works. So I'm sure that many of you are aware of the online travel agency known as Booking.com, which owns Priceline and Kayak. And as you can see, BKNG had sold off towards the end of 2021 and was making a comeback off of its December lows, having reached 2466.52 by the afternoon of January 4th, 2022, which was the first trading day of that new year. And so let's suppose that a trader had decided to invest in BKNG and purchased 100 shares of the stock. Well, that would have cost him $244,652, as you can see. And his problem is that while he's long-term bullish on booking, the stock, like many other large cap growth stocks, doesn't pay a dividend at all. And so unless he does something, he'll have all that cash tied up in his investment in BKNG, yielding him zero. And so suppose that on that same day, he decided to sell a call against those 100 shares. And so he picked a call that would have provided him with cash income equal to 1% of his initial investment in BKNG, which in this case happened to be the 2580 call. And that call has a strike price about 115 points above the current trading price of BKNG. And so you'll recognize that what he's done here is to create a covered call position where, having bought the 100 shares of BKNG, he immediately sells a call for which he receives $2,530 in cash expiring at the end of the month. You see, as we explained earlier, the call represents 100 shares of stock, and so you multiply the 2530 call price by 100 to arrive at the cash flow you'll receive for selling that call. And his plan is to actually do this every month, selling a call that yields him 1% of the value of the shares that he bought, and continuing this campaign for each month in 2022. Now let's move forward to the day that the option expires. And as you can see, BKNG closed that day at 2412.94, which is well below that call strike price of 2580. And so therefore the trader just gets to pocket that $2,530 that he first received when he sold the call earlier in the month. Keeping score so far, that first trade involved cash income of $25.40 for the month of January. And since this is a campaign of selling monthly covered calls on the day the first option expires, he goes ahead and sells a second covered call, this time expiring on February 25th. In this case, he ended up selling the 2670 call for $25.25. And as you can see, that brought in $2,525, which is again almost exactly a 1% return against the cost of the shares. Now again, moving forward to February 25th, the day the second call option expired for February, as you can see, BKNG had sharply sold off to 2281.46 by that day, far below the 2670 call option strike price. And so again, as happened in January, the call expired worthless. And so if we update our scorecard, you can see that we've added to our annual cash flow so far by an additional $2,525. And so running the numbers through the first 9 months of 2022, repeatedly selling a call at the end of each month and allowing it to expire, we can see that through September, each month, we were pocketing over $2,500 per month in almost every case for the first 9 months of the year. Now, in October, something interesting happened, which is that when we first entered the October trade, which is on September 30th, BKNG had sold off all the way down to 1654. And so we sold the 1830 call to collect our covered call premium for that month, and we received a price of $25.15, bringing in $2,515, as you can see from the calculation. But in the final 30 minutes of the day that that October trade was set to expire, the stock was trading at 1867.63, which is a higher price than the call's 1830 strike price. So in order to continue our campaign and not have our shares called away, we needed to buy back that call. And unfortunately, the price of that 1830 call is really high, and it's gotten so valuable because we can buy a stock trading for 1867 for 1830 using the call. And so the option will give you more than a $37 discount on each of those 100 shares that the option represents. And so while we originally sold it for $25.15, it's now worth $40.40. So what we'll do in this case is, instead of letting the option expire, we buy it back for its price of 40.40, which closes the options position down. And then we simply resume our campaign of selling the covered call each month of the year by selling the 2060 call expiring in late November for 26.45. Very similarly to what we did every previous month as well. And we also sold the December call the next month. And so once that December call expired, we'd be in a position to calculate the final cash flow on the full year's campaign. And so as you can see, after collecting around $2,500 per month and subtracting out the buyback of that one call that went in the money, which means that the stock had exceeded the strike price, subtracting the cost of extricating ourselves from that one October trade by buying it back, the entire year resulted in a total of $26,701 in positive cash flow from our ownership of BKNG, which effectively produced the equivalent of a dividend of 10.8% for the year, which completely blows away the average dividend of the S&P 500 component stocks, which actually hovers around 1.5%. And so what I'd like you to take away from today's video is that you don't have to sit there and collect no dividend on growth stocks. You have a way out of that quandary, and that's the covered call option strategy. The options traders on our desk are well aware of the use of covered calls to substantially increase the returns on their long stock positions, and now you've got that knowledge too.
Okay, it's one thing to know how to trade covered calls, but it's another thing to do it the right way and not fall into hidden traps. Click on the video appearing on your screen right now to learn how to avoid the 5 deadly covered call mistakes that can kill your trading account.